Hey there, it's Lydia Desnoyers, CPA, your favorite fractional CFO and business coach. Now, we've all been hearing about Silicon Valley Bank collapsing and what seemed to have happened just overnight last week. And I want to talk about how it impacts your business and law firm. Before I do, let me just summarize for those of you who don't know what really happened. All right, Silicon Valley Bank, or SVB, basically their niche, they've been around for 40 years, and their niche was the tech industry. Now, we all know during the pandemic, the tech industry just shot through the roof, just became the thing. But recently, it's kind of slowed down a little bit. And so investors and startups and whatnot have started to need to pull cash out of the bank. And there were a lot of investors who did that. And so to cover that cash requirement of having to satisfy those withdrawals, SVB had to sell some bonds that they had prematurely, and they took a huge loss, somewhere between $1 and $2 billion. So now more investors got wind of that and started to lose confidence. And this bank, this institution that I had my money in, just lost all this money. I'm going to take my money out. So that's what happened, right? And so it was literally from Wednesday through Friday, all this happened. And so when all these investors started withdrawing their funds, the FDIC kind of swooped in and is like, all right, SVB, you're going into bankruptcy and we're taking over from here. So how does this relate to you? So I mentioned the FDIC kind of stepped in. So let's talk about what the FDIC is. It's the Federal Deposit Insurance Corporation, which is an independent entity that was put together by Congress to help maintain, confidence in the bank industry and to protect account holders. And most bank accounts use that in their promotional material, right? You hear, we are FDIC insured. Now, up until now, we really didn't need to know what that meant, right? We're just like, okay, great. We have some kind of protection. So let's dive into what that means, what it means to have your account be FDIC insured. Should something like this happen at your financial institution, that up to $250,000 of your cash sitting at that bank is protected, that you'll get that back, right? Now, it may take some time because there's bureaucracy. They need to review all accounts and stuff, but up to $250,000 you are guaranteed to get back, right? Now, you may have multiple accounts at that bank account, each account having more than $250,000. Does that mean you get $250,000 per account? No. FDIC insured just means that you get up to $250,000 per financial institution, right? So if you have multiple accounts, each with over $250,000, you're only insured up to $250,000 that you'll get guaranteed. Now, doesn't necessarily mean you won't get the rest. It just means that the rest, or any balance over that, is going to go through normal bankruptcy proceedings. And so when a company goes through bankruptcy, like this bank is about to, secured creditors are going to take priority, right? And before unsecured creditors. And as an account holder, you are considered an unsecured creditor. And so whatever's left after the secured creditors are satisfied and their balances are paid will be divvied up between unsecured creditors. So you may get some, all, or none of the remaining balance, but you'll get at least up to $250,000. Now, keep in mind, this is $250,000 regardless of how many accounts you have. So what does that mean as a law firm or business with an IOTA account and an operating account at the same financial institution, and each account has $250,000 or more? All right. This is where it gets really, really tricky, and why I will encourage you to talk to your financial institution to make sure you understand the implications. Here's the thing with IOTA accounts or fiduciary accounts. So long as it is properly set up as a fiduciary account, the FDIC would consider each of your clients as account holders. Even if you take all the funds and it's pulled into one IOTA account, if you provide detail and say, this is how much this client has in this account, this is how much this client has in this account, then each client is considered an account holder and they'll be eligible to get up to $250,000 of their funds protected, right? So you see how important it is to have proper trust accounting and to do monthly reconciliations to make sure that you have all the detail for each of your clients' balances that are sitting in the fiduciary account that you created on their behalf. So keep that in mind. Now, since your clients are considered the account holders, then that should mean that your operating account is protected up to $250,000 as well. right? That's what it should mean. I implore you to contact your financial institution to make sure that both your operating and your fiduciary accounts are both FDIC insured, and that you understand what those limits are and what the coverage is for each of those accounts. So if nothing else, here are 3 things I want you to take away from this video. One is call your financial institution to make sure you understand the implications of each of your accounts, your operating and fiduciary accounts. Also, make sure you have proper trust accounting and that you are doing reconciliations at least on a monthly basis, and you have a proper accounting of each of your clients' fund balances sitting in your IOTA account. And 3, if you don't have that, we have the course for you to make sure that you have confidence and that you are able to trust your trust accounts. So don't miss out. Make sure that you are compliant, you understand the FDIC insurance coverage, and that you protect your assets and that of the clients that you are representing.